QBI, qualified business income. What is this? We are going to find out together. Now, QBI, it's a tax term, refers to the net income earned by a qualified trade or business, such as sole proprietorships, partnerships, S-corps, and LLCs. Now, do note that there's no C-corps here. We see that. Look at that. Just keep that in mind. That are taxed as pass-through entities. QBI allows eligible taxpayers to take a deduction of up to 20% of their qualified business income on their individual tax returns. So essentially, really what this is, it's a tax rule that allows smaller businesses that follow certain rules to get an extra deduction. So the IRS trying to help stimulate the American economy, right? As they love to do. Classification is necessary to provide tax relief for small business owners, entrepreneurs who typically pay higher tax rates than larger corporations. The deduction is intended to reduce the effective tax rate on qualified business income, and we'll also talk about what is qualified business income, all that good stuff, and help level the playing field for small business owners. Definitely, we don't want to all pay tribute to Amazon and Apple for the rest of our lives. They own everything, and there's only 2 companies left in the entire United States. That would be pretty bad, but who knows? Maybe that's what it's going to look like in the future. Examples of QBI include income from consulting businesses, rental income from a real estate business, or profits from a partnership or S-corp. However, certain types of income, such as capital gains, dividends, and interest income, are not considered QBI. That's passive income. We talk about, especially in the characteristics and attributes of gains and losses, the different types of income. So nothing passive income is eligible there. The IRS wants you out there working, making that money. Additionally, there are income limits and other requirements that must be met in order to qualify for the QBI deduction. Anything that changes year to year, again, we'll have in the resources. Now, a qualified trade or business refers to any trade or business that's eligible for the deduction, excluding this SSTB, specified service trades or businesses. An SSTB, it's a trade or business involving the performance of services in specific industries such as health, law, accounting. Hey, look at that, that's us. Actuarial science, performing arts, consulting, athletics. There's a few others. I'm just going to kind of cut it off there. So it's really just going to be those service-based trade businesses there. Notably, engineering and architecture are strictly excluded from the SSTB category. But just a good overall general idea of what the heck this is. Again, that was the goal of this slide. We're going to keep running through. I've got formulas for you as well on how to actually use QBI. And then when you see questions on QBI, bring up those formulas, use them to help you pass and knock them out. All right, now here is how it works. This is just a big formula, right? Well, and I will get into more of the formulaic slides as well. I've got it in different formats as well. I've got to love that, because if you don't like how it looks on one slide, maybe you like how it looks on the other. Everyone's a visual person. I hear that a lot. I'm a visual learner, the amount of times I heard that. All right, so the actual deduction, how do we calculate it? Well, the QBI deduction is limited to the greater of 50% of the W-2 wages for the business, or 25% of the W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition of qualified property such as PP&E. Now, you're like looking at this and you're like, Nick, this is insane. Like, what is this? Explain it further. Just like anything, right? If this is intimidating, if this is a lot, there's step 1, which is just memorize. And this is not shocking news to anyone. This is one of the exams that is very memorization heavy. I mean, so many of them are very memorization heavy. Step 1 is just memorize the stuff, even if you don't understand it. Step 2 is understand it, and step 3 is put it all together. And it's with that you're going to do well. So if you just memorize this straight up right now, that's fine for now. Obviously, we want to understand as well, revisit lessons as you need to. Now, additionally, the overall limit for the QBI deduction is the lesser of the combined QBI deductions for all qualifying businesses, or 20% of the taxpayer's taxable income in excess of capital gains. And yeah, this is really going to make the most sense once we start seeing it in questions and running through all of that. So just keep that in mind. Don't get overwhelmed or intimidated by anything. This exam, this prep here is meant for the best learning experience we can provide. Now, the QBI deduction does not include salary or guaranteed payments for services provided by the taxpayer. In cases where a business has negative QBI, the deduction is affected as follows. Now, if there are multiple businesses and one has negative QBI, the losses are allocated pro rata to businesses with positive QBI. And if the total QBI is negative, the QBI deduction is 0 and the loss is carried forward. Lastly here, aggregation rules apply only to qualified trades or businesses and must meet specific criteria. The same person must own at least 50% of each business, and at least 2 of the following conditions must be satisfied. First off, the business offers the same products or services or offer them together. The businesses share facilities, and the businesses operate in coordination. Now, what I would recommend is whenever you see a question about QBI or anything like this, pull up these slides, reference them. take a look and see how does this help. Now, like something like this, I'll say you're probably not going to see too much. This bottom one here, we do include it because you can see it and you can see it in a question. Also, give some background on it. But as you see questions about QBI, especially complex formulaic questions for anything in the exam, pull up the slides, reference them, and use them. Use them to your benefit. All right, here we see an example here. We've got a business. We've got John. John owns 2 qualified trades or businesses. We got business A and business B. John has the following financial information for the current tax year. Business A has QBI of $100,000, W-2 wages of $60,000, and UBIA of qualified property of $200,000. That was like the last rule, the 2.5% that we'll see. Now, business B's got, it's got more information, right? 50,000, 40,000, 100,000. Sounds good. Now, John's taxable income, excluding capital gains, for the tax year is $150,000. Now, first, we're going to have to calculate the QBI deduction for each business, which is subject to the W-2 limitation. First off, we've got business A. Here, this is 50% of W-2 wages. As we know, we have to run through our check here. That's $30,000. Then we're going to say 25% of the W-2 wages plus 2.5% of that UBIA qualified property. So we see here 25% of the wages, and we're going to add that to 2.5% of the property. That's going to give us $20,000. So the deduction is limited to the greater of these two amounts here, which is $30,000. So that's kind of how we do that first step, right? I told you it's going to make a lot more sense when we see examples. And here, this next example, doing the same exact thing for business B. I'm not going to run through that again, but feel free to look at how it works. So, all right, that first step, now that we saw how it works, not too scary, not too intimidating. It's a lot, but the whole exam is a lot. Next, we need to apply the overall limitation based on the taxable income. Now, we are going to see 20% of the taxpayer's taxable income in excess of capital gains. That is going to be 20% of the $150,000 that was provided here. That's going to give us $30,000. And then the combined QBI deductions for both businesses, that is going to be $30,000 from business A, $20,000 from business B. That's going to give us $50,000. So the overall limit for the QBI deduction, it's the lesser of these two amounts, which is $30,000. So here, John's QBI deduction is limited to $30,000 due to the overall limitation based on his taxable income. And that's a deduction he's going to be able to take on his 1040 on his tax return. That's the whole point. That's what we're doing here. We are understanding that, all right, John's got these qualified trades or businesses. It'll probably tell you it's a qualified trade or business. They're not going to trick you too much on that. Your job is going to be, you've got enough as it is, understanding this process and making sure you're able to knock it out. All right, now we've got a reduction here, which it's not fun, right? Who wants to reduce a deduction? A deduction is beneficial for you, but reducing that deduction, not fun. So the reduction to the qualified business income deduction, it's meant to limit the benefits of the deduction for higher income taxpayers. Now, just as you thought we had a good thing going, the IRS comes in and says, we're going to reduce that deduction you get. The QBI deduction allows taxpayers to deduct up to 20% of their qualified business income from a pass-through entity, such as a sole proprietorship, all those different types of entities. The deduction, again, aimed to provide small business tax relief, all that good stuff, wonderful, everything there. Now, the reduction concept comes into play when a taxpayer's taxable income exceeds certain threshold amounts. These amounts you see here are not the current amounts. These are the amounts that were introduced with the Tax Cuts and Jobs Act of 2017 that began in 2018. So these were the initial amounts. These are adjusted for inflation, and they will be in the resources for you there. So make sure you have those memorized. Now, when a taxpayer's income exceeds these thresholds, the QBI deduction can become subject to limitations and phase outs based on the taxpayer's income level, the type of business they operate, and other factors. And we saw phase outs before. If you're below this amount, cool, ignore it. You don't have to worry about it. If you're above this amount, cool, ignore it. You just don't get any QBI benefit. That sucks. It's not fun. But if you fall somewhere in the middle, then you get a partial benefit. The reduction process is designed to gradually limit the QBI deduction based on the taxpayer's income, ensuring that those pesky high-income taxpayers do not disproportionately benefit from the deduction. The reduction can be based on a combination of factors, such as the amount of W-2 wages paid by the business and or the unadjusted basis of qualified property used in the business. Now, the phase-out range for the QBI deduction is between those initial threshold amount. So again, the original amount here, right, was going to be in 2018 when this was established, the phase-out range for the QBI deduction. This is for single filers and for married filing jointly. Now, within this range, QBI deduction is gradually reduced or limited until it's entirely phased out for taxpayers with income above the upper limit. Now, in that example we have for the adoption credit, we saw that the difference was $40,000. Here, we're going to see that the difference is $50,000. Now, by applying the reduction concept to the QBI deduction, the tax code is going to have that balance, right? Equitable stuff, yada, yada, all that good stuff. That's something we are going to see. This does vary in importance from exam to exam. Will you see this? You could see it. You may not see it. I know some people definitely do see it. Some people don't see it. It just depends. I'd be prepared for it, just like you'd be prepared for most things that we prep you for here. And here, this is, I will claim credit for this. This is, I wrote this out. This is based on doing a bunch of different QBI deduction reduction questions. That's a mouthful as well. These are the 7 steps in how to actually deal with the questions involving the reduction. So memorize these steps. We will have questions for you that deal with this. So make sure you're familiar with this. This is step 1 is just memorize this. Step 2 is going to be applying it, and you'll be good to go for these questions. If you were curious, not that this is too important, of understanding the tax form for it, but here is the tax form where you'll see the QBI deduction. This is form 8995. Really don't need to know this, but just including it in here if you were interested. And here is where the QBI deduction would fall on the 1040. Now this I'd say is important because, again, you could see a sim that is essentially 1040, and yeah, well, they're not going to completely leave you out to dry and have you memorize which line item is what. It will be helpful to know where each of these deductions go, and the more familiar you are with the overall process, the better off you will be. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.